Should you invest in dividends or real estate for passive income? This is the exact question that I want to help answer for yourself in today's video. And I'm going to go over several factors that are going to see which option is going to be a better choice for yourself in your investing journey. Now, in this video, I want to make sure I go over that with dividends versus real estate. In the real estate category, I'm going to use being a passive investor or a limited partner in real estate deals where you are not going to be a landlord and more of the passive route. And I want to use that as a comparison to make it more easier for the comparisons with stock market dividends. Now, if this is the first time you're coming across my channel, I just want to welcome you to the Passive Income Therapist. And I'm here to help you educate on how I've accelerated my overall financial wealth faster than being an average investor. And I want to help educate you on the same things that I have learned from the wealthy and implementing those in my own investing journey. So that's enough for me. Let's go ahead and dive into dividends versus passive real estate. So I've mapped out 6 factors that you need to look at to see which one is going to be your best option. So number 1, we have capital, or how much capital that you have to invest. Number 2, liquidity. How easy is it to able to get your money in and out of that asset? Number 3, taxes. So are any of these going to provide tax benefits for you? Number 4, distributions, or how often are you going to be getting distributions for passive income? Number 5 is cash flow. How much cash flow can either of these options usually produce on average? And then number 6, how likely are your assets going to be appreciating over in time for the value across the lifetime that you're going to be having that asset? So number 1 is capital. So for dividends, a lot of times you're going to be able to just put the amount of money that you're able to do in a regular stock. So with capital that it's going to take to be starting able to invest in dividends, it's going to be relatively lower. There's going to be ones that you could be buying for single dollar type of share amounts, all the way up to ones that are in the 3 figures amount. But if you are looking to allocate more money than just a couple $100s or in the thousands, once you start getting into about the 5-figure amount for investing for dividends and passive income, real estate might be a better option for you, because a lot of times these are going to take a little higher amounts of capital to further go into invest in these type of assets. Number 2 is liquidity. How ready available do you need your money to be able to move in and out of that asset class? So with liquidity on dividends, overall, it's going to have a fairly good amount of liquidity that you can get those in and out of. So think about just the stocks. You can essentially pretty much sell those stocks for the dividends on that same day, where you're going to be able to get in and out of that asset class pretty fairly easy. Now, if you are looking over the long game for investing in more of the passive income, real estate might actually be a better option for you, because this one is going to be pretty illiquid. Now, there are certain situations where you're going to be able to get your money out for certain instances and circumstances that come up, but you are not wanting to invest in real estate, especially limited partnerships in real estate. If you are looking to get your money in and out quickly, there are definitely several type of deals where you can do that, but to invest in cash flowing passive income over the long haul, you want to make sure that you are going to be comfortable with leaving your money in there for several amount of years. Whether that could be a year, 2 years, or could be even from 5 to 7 longer hold time. And that's what the usual typical real estate deals look like with passive real estate deals, at least the ones that I do. So real estate is going to be a little bit more illiquid, but it's going to be over the long haul. Now, one thing I want to make sure I do go over about real estate is that even though it is illiquid, where it's a little harder to get your money in and out of, there are several times where you can be in real estate deals where it's going to be a refinance period. What essentially refinancing means is that at the time when your real estate deal goes up in value, there's going to be a point where you can get a lot of your capital out, if not all of your capital out, that you initially invested in with that real estate deal. So say you invested $10,000 or $50,000, whichever example that you want to put. When you're investing that money into that deal, if there's a refinance period that they're going to utilize on that real estate deal, you're going to be getting that money out of the deal. Even though if you're going to hold that for 5 years, but in year 3 they want to do a refinance, that means in year 3 you're going to be able to get some, if not all, of your original capital out. So you're going to get that money back earlier than that ultimate longer hold time. Now, the big aspect when investing in real estate, as well as limited partnerships and passive real estate deals, is that even if you're not playing an active role in that type of deal, you are still going to be able to get what's called depreciation that's going to help offset your passive income gains. So with the passive real estate here, you're actually going to be getting tax benefits that's helping offset your passive income gains. So say if you invest $50,000 into that real estate deal, you're going to be getting a certain amount of percentage based on the value of that property, as well as the amount of depreciation that you're going to get. And you're able to use that depreciation to help offset your passive income gains that you are getting from the real estate that's throwing you out passive income and cash flow. Now, this was definitely a big light bulb moment for me, because when I learned how the wealthy are investing for passive income and cash flow, yes, dividends might be better at the beginning stages of your investing journey, but as soon as you can get over into real estate investing, as well as being a limited partner in real estate deals and real estate syndications, the faster that you're going to be able to accelerate your overall financial wealth, because you're going to be able to utilize depreciation and other tax benefits that the real estate has to offer to lower your overall passive income gains with those taxes, and you're going to be able to lower your overall income taxes. Now down to number 4 are distributions. Typically in stock market dividends, these are going to be usually quarterly. Now that's very typical. And with real estate deals or real estate syndications, these actually can be monthly or quarterly. So I'm going to put monthly as well as quarterly. And when it comes to certain sponsors that are going to be with real estate deals or real estate syndications, it's going to be based on the preference, but you can either look for certain real estate deals as well as sponsors that are going to be giving you distributions monthly or quarterly. Now to number 5 is cash flow. So for stock market dividends, like we already touched on, that they're going to be quarterly, usually for those distributions. And with cash flow, these tend to be overall lower than the real estate. So I'm going to put a little bit of a middle line to where that cash flow is going to be overall in the middle grade. So a little bit more than a high yield savings account right now. High yield savings accounts are usually around that 4%. And typically with cash flow, with dividends, you're looking about a 5 to 6% overall cash flow with those distributions over a year, or average rate of return over that year. Cash flow when it comes to real estate deals, it can really vary depending on the type of real estate deal, but at least for me, the typical type of deals that I'm usually used to seeing is going to be anywhere between 6 plus as far as percent on that cash flowing term for the average rate, as well as anywhere up into about a 9 to 10% cash flow on that year-to-year basis. Actually, my first real estate syndication deal was a triple net industrial deal, where straight out of the gate, the month after you invested in that deal, I was getting straight 9% yield on cash flow on my money in the first year. So definitely when it comes to looking at the dividends versus real estate, the cash flow is going to tend to be a lot higher. Now, if I touch on liquidity, and if I go back to how real estate is a little bit more illiquid, if you're going to put your money on some sort of more illiquid type of investment, you want to make sure that you're going to get a higher chance of rate of return as well as for that cash flow. So if you don't mind putting your money to work for you a little longer term and being a little bit more illiquid, you want to make sure that you're going to get a overall higher rate of return. And if that is the type of investor that you want to be, I would definitely look at more of the real estate or passive real estate deals, where a lot of times that cash flow is going to be higher than the type of cash flow that you're going to get in the stock market dividend. So even though though we're focusing on passive income as well as cash flow in this video, I also want to touch on appreciation just because you want to make sure with your asset that you are going to be investing in, number one, it is going to be creating passive income or those distributions that you'll be getting throughout the year, but you also are looking at capital preservation or trying to make sure that you're preserving the amount of capital that you originally put in and you're not necessarily losing money. So with dividends in the stock market, when it comes down to appreciation, a lot of times the higher cash flowing type of stock market tickers out there, they're going to have an overall lesser amount of appreciation that you're going to potentially have in the future. When it comes to appreciation, I'm also going to put a little bit of a middle ground on appreciation just because it tends to be those dividends in the stock market don't really provide a lot of appreciation over time, and it's really more so along that cash flow. So appreciation could be a couple percentage points every year with that, but it's going to be relatively low on appreciation. Now, when we go over to real estate with the passive real estate option there, even though we're tending to get a little higher cash flow, the overall appreciation amount throughout the year is tending to be a little overall higher than your regular stock market dividends here. With the appreciation, at least with the deals that I've come across and the typical type of investments that I made, the typical type of appreciation amount for an average rate of return or IRR, for lack of or more simplicity, is going to be anywhere around a 15% plus amount overall rate of return per year. So even if you are looking at a 6+ or even a 9+ IRR, or not necessarily IRR, but cash flowing number for every year on your money, your overall rate of return when it comes down as you are ending that life cycle of the deal is usually going to be right around that 15% mark. Now, with the type of deals that I do, that's pretty average. There could be a little less, as well as there could be definitely a lot more. But the usual amount that they typically try to target on a conservative measure is going to be 15%. So it's really hard when I've looked at dividends, when I was first getting into cash flowing assets with stock market dividends. A lot of times you are not going to really get that 15% mark overall on your rate of return for investing in dividends. Yes, you're going to get some good cash flow, but the overall amount of potential for appreciation doesn't usually add up to all the way that you could get in real estate. Now, if you haven't figured it out now, I am more on the real estate investing side for passive income, just because I've been able to implement all of these factors and look at these just like the wealthy. And the wealthy are not necessarily just looking at dividends to create cash flow and passive income for themselves, but they're also looking at the other tax benefits that the real estate has to offer to help offset your passive income gains. So anytime that you're going to be investing in the right type of deals for passive income on the real estate side through real estate syndication specifically, that's what I do for the last several years now. You're going to get overall greater rate of returns, especially when you're going to lock in your money for a little longer, but also you're going to be able to offset a lot of your passive income gains that you're going to be getting on those returns that you're getting through cash flow as well as appreciation overall at the life cycle end of the deal. So those are my top 6 factors when looking at dividends versus passive real estate to see which one is going to be better for you for creating passive income for yourself. Now, if you are intrigued by passive real estate investing, I have been investing in real estate syndications for the last several years now, and I've been able to, number one, accelerate my financial wealth, as well as number 2, help offset my passive income gains with depreciation in the tax benefits that the real estate has to offer, even when you are a limited partner or a passive investor in these type of deals. So if this seems to intrigue you, definitely follow me for more, and I look forward to seeing you in the next video.